Welcome back to the Investing on the Go podcast brought to you by FundCalibre. Gold and silver markets have seen dramatic swings recently, so we explore why volatility is part of the metal's natural cycle and continued opportunities.
Hello, I'm Darius McDermott and I'm from FundCalibre. Now, whenever I host the podcast, I'm obligated to say how excited I am about the up and coming 20 or so minutes. And we booked this in our diaries probably somewhere between 3 and 5 weeks ago. So it's with absolute delight. I've got Ned Naylor Leyland, who is the manager on the Jupiter Gold and Silver Fund. Ned, good afternoon.
Good afternoon, Darius.
So when we booked this in, it was just straight. Everything was going up every day. It felt a little bit lucky, but it was just going up. Then the day of the announcement of the new Fed chairman, I don't know if that triggered it or not, but it then started going south in quite a spectacular fashion. And since then, it's been up and down like the proverbial yo-yo. So look, you don't want to listen to me. You want to listen to Ned. What's going on?
So thanks for the opportunity, Darius. Look, so what happened in, I'm going to rewind slightly further back than that. The year previously is that gold attracted a lot of leverage from sophisticated hedge fund, CTA style trend following people. In other words, they're more sophisticated than retail, if we put it like that. Whereas with silver, what happened is we got a lot of excitement in January where people were not just buying physical silver down the bullion dealer, they were, let's say, being rather overly attacking in the way that they were approaching the silver market. And you are right, that's exactly what it was. It was the announcement of Kevin Walsh as the nomination for Fed chair. There are other interesting topics surrounding that, which I'm not sure we have time to get onto today, that made the market think, gosh, maybe the Fed will be less accommodative than was expected. Now, of course, gold and silver are always about that. So if we're in dovish mode, they go up. And if we turn hawkish, they go down. So really, all that happened was we had a very, very brief, but for people who had borrowed money to go long silver, painful trend reversal, and we had a liquidation event of people who were on margin, who had borrowed to fund that trade. Now, from my perspective, Darius, this is all very good news because really there are three kinds of people that we need to think about with gold and silver. One is those people who are borrowing and were overly excited. Well, they got washed out. Good for them. I'm not worried about them. That's their problem. Move along swiftly. Indeed, a clearing of the decks of all of that is always a good thing. The second class of people are the people on this podcast listening and you and I, which are what we would describe as stackers. They are physical metal, and they are long the mining companies. And really, none of this was a massive surprise. We did have a deleveraging event in October as well. Actually, quite similar, just not as big. Both of them are purely technical. They allowed for a reset and they allowed for then the next move to start. And then the third, and probably the most important cadre of all, are the people who are not in and are looking at this going, gosh, do I need to be in gold and silver? And the answer is they do need to, and they've been waiting for an entry point. And what we saw, whatever it is, 10 days ago, was a moment which I think they've mischaracterized. They looked at it and thought, gosh, thank goodness this is all over. We don't need to worry about it. And as and when the dollar gold price, because really it's always about the dollar gold price rather than silver comes alongside. When that gets back through $5,500 an ounce, which I believe it will do in relatively short order, for me, that will be the moment where those people start to think, wait a minute, what's going on here? This is still happening. And I think then you're going to see a new wave of interest in this topic of debasement, only gold and silver and all the rest of it.
So I think now's absolutely the right time to say, at time of recording, because I checked just before we came on, gold was $5,040 and silver was $82.50 per ounce. So let's get that nice and public, because some of the hot money, your words, got burned out. And I know they're linked, but they are quite separate metals. Gold has more central bank value, and I know a lot of the demand has been coming from there. Actually, silver is a proper industrial metal in its own right, and I think the sort of supply demand is we need twice as much as we've got. The other thing I know, and I've never done mining, is you just don't go down the high street and open a silver mine tomorrow and get loads more supply. So I know predictions are a fool's game, but you and I are on this call, so maybe we can be a bit foolish. Where do you think these two metals settle at when there isn't the exuberance, or because of the potential for the new buyer still to come, that actually we are going to have volatility and leverage? And I do want at some stage to come and talk about the March deliveries, which is a nice additional technical for us to go through.
Look, I think that the thing to realise is that leverage and volatility and flow is central to every asset class now. Whether you look at Mag 7, Nvidia on its own, or gold and silver, people don't like buying stuff, or a lot of people don't just like buying stuff in cash. We do, the people on this podcast do, but there's a much wider selection of investors that don't want to do that. They want to get more excited. But the first thing to say is that gold and silver directionally are the same thing. You are right that silver is also an industrial metal, but they move together. In other words, gold up, silver up. Gold down, silver down. You don't find the two things decoupling from each other. You are with both gold and silver, short politicians. Okay, so that's what you're doing. You're saying, I want to be short my local currency, in our case, sterling, and the behavior of politicians. It's just that with silver, you're also long conductivity. So you're saying, I want to be both short the politicians and long the future through tech, etc. But they do move together. It's a very important point. But I think that it is fair to say that because people now like things to move around a lot more than they did in the past. You'll remember, and I certainly remember, that 10, 15, 20 years ago, people were scared of volatility. Now there are a lot of investors that actually want that. They like things to move around a lot. That silver has become more exciting for investors to jump in on. So you have to be aware that there will be accentuated volatility, leverage, sizzle that goes with silver over and above gold because it moves around more.
Yeah, I totally accept they move in the same direction. The velocity of the movement is different. Gold has been having, 2, if not 3 good years, where it's gone from roughly 2,000 to 5.5 on that Friday and 5,000 as we speak. Whereas silver really only started getting its act into gear in the second half, and then December and January, when it doubled again. I mean, it doubled in a month, the spot price anyway. So yeah, I think you're absolutely right. The volatility is here to stay. I think for me as an investor, it's where might these prices settle? Because then we can talk about the value in the miners. Because I know what you're going to say, because I know at these prices, the miners are really, really, really cheap.
They've never been so cheap. So you'll keep pushing me for a price prediction.
Well,
I like to avoid, but I'll go there slightly. What I'll say to you is this. When gold goes up, if we want to say it, of course, it's not really doing that. It's measuring how much your currencies are going down. What you tend to find is the trend is what you want to watch. So whatever quantum gold has moved in sterling, in our case, or dollars, in the previous year, absent a change in policy, and I don't think any of us are expecting that, then you should expect similar next year. Now, that's quite a big number. So if you work out what gold did last year, then I'm suggesting there's nothing unreasonable. It's suggesting a similar sort of behavior next year. So I think that's right. Now, the thing about silver, as you know, is the market's kind of broken now. It's sort of fractured into several different pieces. We've got different futures prices in different locations, different spot prices in different locations. You've got delivery failures. When silver went from 120 to whatever it got all the way down to 75, you couldn't buy silver at 120 or 75. So, which is the only thing that's annoying for the stacker, that second set of people I mentioned, is that it would be nice to have been able to buy 15 kilos of silver at $75. But of course, there's no silver to buy. No. So, look, I think silver will do more than gold. The cat's out of the bag on that. And you're right, the miners, I'll give you an idea of trying to explain this in a simple way. The profitability of the mining companies, they had 15% free cash flow margins 8 years ago. So 15% of the 15 cents in a dollar was available for dividends and buybacks and merger and acquisition activity, etc. And they were trading on 1.5 times net asset value. Now they have 50% free cash flow margins So that's more than 3 times the margin, and they're trading on 1 times. So they're 33% cheaper now, but 3 times as profitable. So you are right that they are extremely attractive. And really, when we saw this big drawdown in the spot silver price, or the future silver price, whichever way you want to look at it, the miners did not move nearly as much. Now, that's very irregular. So that means, for me, the real excitement for the next year and 2 years finally is in the miners rather than in the metal.
Now, outside of the Fed news Friday before last, there is, and you use the word, and you're not the first person I've heard say this, but the silver market is broken. Let's talk a little bit, in the best as we can in layman's terms, about what's in the foreseeable future. And colleagues far brighter than me tell me that there is 4 times as many future silver contracts to be delivered in March or rolled as there is silver in COMEX, which is where it's held in the States. Well, I mean, if people call it, then surely the silver price is off to the races. If because they just won't have the silver to deliver. Well,
look, it's a complicated point, because I think the key here is the overall market leverage. So what you're saying is that if everybody stood for delivery in March, there's absolutely no way that it can be done. And that's true. And it does look extremely interesting. And people like me have been waiting for this for over 20 years, by the way, the point at which this would happen. But I tend to think that the way things work nowadays, the idea of an outright failure is quite unlikely. What you're more likely to see is a sort of series of rule changes and requirements, and the fractured or broken market we're already seeing will just become more obvious in different places, bigger premiums being paid in different locations. We are also seeing the same phenomenon, of course, in Shanghai. So in Shanghai, the stocks of silver that sit behind the futures market there are also being drained. So there's no doubt there is a rush for physical and a rush away from paper. The 24-year-long gold and silver bug in me tells me that these things never happen on the date that you're expecting them to happen. So I would tend to say it looks extremely interesting, but let's actually get to that point before we start raising the bunting. But what I will say is all of this drives you to think about 2 things. One is real metal ownership. So not owning a promise of silver, whether it's futures, whether it's unallocated silver, whether it's a synthetic promise of silver. All of this is telling you want to do it properly. Do it as well as you can, because gold and silver are always about counterparty risk. The reason you own gold and silver is you're worried about counterparty risk. And what you're saying is surely the counterparty risk is off the Richter scale now. And the answer is it certainly looks interesting, Darius. There's no doubt about that. But it just drives me to want to be more of a stacker and own the metal and own the miners. Because the thing about mining companies is you've got 1 times clean ownership of the future stream production of a silver mine or a gold mine. And that is a very good, clean way of representing ownership of what is a very financialized and paper structured market.
So I think that's a perfect segue into your fund and what you do. So I'll simplify it, then I'll let you sort of expand. But Ned's fund invests in physical gold and physical silver. And I would let you say a little bit on that versus potentially ETF or other vehicles. And then invests in gold and silver miners. And Ned moves the balance of those 4 depending on where we are in the cycle and his view on those assets. So maybe let's just touch on the physical stuff first.
Yeah, so the best way to own physical gold and silver is not in my fund, it's yourself. And the reason is because of what we just said, which is if you take delivery of physical gold and silver, you've removed all counterparty risk and you've taken ownership yourself. Now, accepting that's not for everybody. And
I was going to say it's not very practicable either. And
no, it's not, but it's an important point, which is if that's your starting point, which is that's something one can do. But if you want to own it on the screen, in whatever way or in a portfolio, there are myriad different ways you can express ownership of 1 times the gold price, 1 times the silver price. And all that matters to me, therefore, is worrying about the counterparty risk. as you know, my fiduciary duty to make sure we don't have a problem there. So that leads me away from exchange traded products and towards what are called bullion trusts, which is what we own in the fund, and they are listed on the New York Stock Exchange. So they're covered by the Securities Act. The physical gold and silver is held outside the banking system. It's just a de-risking process. Now, I feel the same way about mining companies, as you know, which is I don't feel like I need to be in Africa or Central Asia or whatever. Now, maybe occasionally we miss something because we narrow our universe to what we call tier 1 and tier 2 jurisdictions, which can, by the way, also be spicy at moments. It's everything about this space. De-risk first. Be very, very focused on what might go wrong. Really think about that a lot. And then when you're comfortable with what the parameters that you can operate within are, and in physical gold and silver, in my view, its own bullion trusts, not exchange-traded products, then you can start to add silver, add development companies, think about the overall spread of instruments you own.
Do you do any of the royalty companies within gold or silver, the likes of Wheaton springs to mind?
We do own Wheaton Precious Metals, yes. I think that we're entering an environment because, as you say, they're so profitable now, these companies, they have lots of cash. They don't need to strike new deals with the likes of Wheaton Precious. There's a lot of capital available, there's a lot of cash available. So I don't think the market is the same as it has been for the longest period, where financial services businesses like Wheaton Precious Metals, which is what that really is, they lend short to a mining company for discounted production in the future. I'm not sure the business model long term is as robust for growth as it used to be. But yes, we have a slug in there. And the good news about those companies is that they distribute their risk across 100 or so individual streams of royalties, rather than being a mining company with either 1, 2 or 8 different projects.
So let's maybe just go back to silver a little bit. Tell our listeners some of the uses, the day-to-day uses that silver is used for. I mean, you mentioned the word conductivity, but what sort of industries, and let's get back to boring commodities one by one, which is the actual demand and the supply, less the financial engineering that we've witnessed recently.
Sure. So most commodities have quite narrow use cases. The thing about silver is it doesn't. It's used in more or less everything that powers the modern economy because it's the most conductive element. So people have heard that copper is conductive, and copper is very conductive, and it's used in large construction projects. But silver is the most conductive element, and it's used in everything in the electronics and digital world. Indeed, that's also why it's used in solar panels, because it's so conductive. So the thing about silver is it's, with the exception of solar, used in very, very small amounts in increasingly miniaturized products. So we're in a world of hyper optimization, where everything is getting smaller and more efficient. And that means that silver is more and more vital to be used as a conductor, whether it's in a keyboard, in a TV, in anything in electronics, but also in military equipment, in cars, in pretty much everything, Darius.
Yeah. Again, I've known you a long time, and I can sort of guess at the answer, but you're a believer that people should have gold particularly, but gold and silver as a consistent part of a portfolio throughout the cycle. But yet we have retail investors and the commentary we write for all sorts of different people, it's got very noisy. I just wonder, with silver going from whatever it was, $10, $15 to 125, and now settling, I use the word settling with a very small S, at about the 80 mark, and gold having gone from 2,000 to 5,000. Have they missed the boat? Your listeners to this podcast who maybe think, I haven't bought an allocation. Is there a FOMO aspect? Or no, don't worry about the price rises. This should be a bit of your portfolio at all times.
Well, I think it should be, my opinion is it should be part of people's portfolio at all times. The reason it's not is more to do with benchmarking and the way that you guys behave in terms of your benchmarking. But look, I think that the thing to think about in terms of a long-term allocation is gold is the principal reserve asset of the central banks and the state. It's what they hold as their asset. And I find it quite interesting that investors' portfolios are entirely dependent on the language of the central bank. So if the central bank comes out with a word that wasn't expected, like windy, the value of their assets flies all around the screen. yet they don't behave the same way as central bankers. And central banks have been adding gold solidly for 16 years now. It's just been a kind of, in fact, 17 now. It's just been a relentless pile-in by the central banks themselves into this reserve asset. So I think it is a point worth considering, which is you're listening or naturally your portfolio is moving based on the language of a central banker. So potentially acting accordingly would be, a sensible thing to do. Now, as to answer your question, are you too late? I'm just going to refer to the point I made earlier, which is unless you think that central bankers and governments are about to be disciplined, effectively go from cutting and being accommodative in the monetary system to being hawkish and raising interest rates, then no, you're not too late. It's always that. It's always to do with that. So it is a long cycle observation. Yes, it's clear that gold and silver diversify, but short term, the price of silver got overbought because of leverage. But as for these metals in people's portfolios, short term overbought, but very clearly underowned at a portfolio level for investors globally.
Ned, thank you very much. That seems like a natural place to draw to a close. If you would like more information on the Jupiter Gold and Silver, which is elite rated and run by Ned and his team at Jupiter, please do visit FundCalibre.com. And as I'm sure my colleague will print, nothing we've said here today constitutes advice, just a good, healthy debate on what really has been probably near enough the only story in town for the last 3 months. So, Ned, thank you very much for your time yet again.
A pleasure.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.